In investing, one of the biggest questions that any investor will have is, can I buy now or not? Or in proper English, it would be, what is the true value of the stock? Because by knowing how much a stock is worth, you will then be able to tell whether a stock is overvalued or undervalued and whether it's a good buy at the current price. So in this video, I'll be showing you how you can find the value of a stock using something called Discounted Cash Flow Model, or short for DCF. This is a model that's used by analysts worldwide, including our Warren Buffett Gong Gong himself. Also, I've recently set up a new Telegram channel where you can join in to discuss anything related to personal finance and money and to ask any questions that you may have. So, what exactly is a DCF model? When we think about a company, we think of it as a business that has hundreds or thousands of employees working for them. The company has factories and plants all around the world, and they make items to sell, which they will earn money from. But if we zoom all the way out, in essence, a company is nothing more than a money printing machine, where the sole purpose of it is to print money, something that Papa Power may be interested in. So let's say there's a money printer out there that prints $10 million a year. How much money would you then be willing to pay to buy this money printing machine? And that is what the DCF model is trying to find out. It is built upon an important concept called time value of money. Huh? Time value of money? What's that? Can eat one nah? Here's a simple example to understand this. Let's say if you can choose between getting $100 today or getting that $100 tomorrow, you will definitely choose getting that $100 today, right? That's because you will then be able to invest that money to earn even more money, assuming you don't YOLO into random meme stocks and lose money, of course. So that's the DCF model. Basically, it tries to calculate what is the total amount of money that a business will generate in its entire lifetime, then tell you how much all that is worth today. So without further ado, here's the DCF model. Just kidding. We won't be using that formula directly because even I also don't know how to use it. Instead, we'll be using this beautiful spreadsheet that I built, linked down below in the description. Okay, I know it looks complicated, but it's actually quite easy once you understand it. Let's go through this together. First up, let's enter the ticker symbol of the stock that we want to analyze. I'll just use my favorite stock, Apple. The spreadsheet will then automatically pull in the price, total shares, and the market cap of the stock, like magic. The second step is to figure out the free cash flow of the company. Free cash flow is the operating cash flow that the company has generated from its expenses after paying for its capital expenditures, stuff like purchase of buildings, land, equipment, and so on. There's a lot of different formulas to calculate the free cash flow, but the easiest way is to go to Yahoo Finance, click on the Financials tab, Cash Flows. Since we don't have the full amount for this year yet, we can use the trailing 12 months free cash flow. Copy it, head back to the spreadsheet, then paste it in. This will be in the millions, so I'll just remove the 3 zeros at the back. Okay, now that we have the free cash flow for the first year, the next step is to project how much free cash flow the company will generate in the future. To do that, we need to first ask ourselves, what will the company's growth rate be for the next 10 years? Quick pause. One thing I like about Tiger Brokers is that it lets you discover new investment opportunities. In the app, tap on quotes, discover opportunity, then bull list. This list lets you find the top performing stocks in different periods and different markets. It will show you the winning rates and the stock performance. This gives you a good starting point for investors who are looking for potential stocks to research and invest. Also, if you have not signed up to Tiger Brokers yet, if you sign up now and find your account with 1,500 Singapore dollars, hold it for 7 days while completing 5 buy trades, you will earn a 3-day 20% U coupon, 40 USD worth of Apple fractional shares, and 1 free stock worth up to 285 Singapore dollars, and an exclusive 30 USD Tesla fractional shares for my viewers. And of course, you will also get a whole bunch of zero commission trades for stocks and options. So if you are interested, you can sign up using my link down below. With that being said, let's get back to the video. Now, of course, you can be like, obviously the company is going to grow 100% every year for the next 10 years. Can is can, but you will most likely end up with some crazy number and your DCF model won't be accurate. So you need to be honest with yourself here and come up with a more realistic growth rate. If you don't have a number in mind, one easy way you can do this is by heading to the analysis page, scroll all the way down, and here you'll find growth estimates for different periods. What we can use is the next 5 years growth rate. In this case, it is 7.86%. Copy it, head back to the spreadsheet and paste it in. Now, in order to project the free cash flow, all we need to do is click on this cell, type equal, choose the previous cell, multiplied by 1 plus the growth rate. We can then add a $ to the E and 2 to anchor the value. And to project for the remaining years, you can just drag the box all the way to the 9th year. But now, we have a problem. We can't predict anything further than 10 years because it's too far out and anything can happen after that. Meanwhile, the business will obviously continue to run and generate cash flows, right? So one solution is that we can just assume that the business will continue to grow at a fixed rate forever. The term for this is called terminal value. To get the terminal value, we will need two numbers. The first number is the perpetual growth rate, which is how much do we think the company will continue to grow after 10 years. For this, we can use the GDP growth rate of the country. Because if you think about it, the entire country is just one big company. And based on the mean reversion theory, once the company has grown too big, its growth rate will eventually slow down to match the growth rate of the country. I would say that on average, it will give a steady PMVP 2.5% growth per annum. So let's enter 2.5% into the perpetual growth rate. The second number that we need to calculate the terminal value is the discount rate, or also known as the weighted average cost of capital, short for WACC. WACC. In very simple terms, WACC is the rate of return needed to pay shareholders and bondholders. Because remember, when we invest in a company, we are looking to get a return on the company. This WACC calculates how much return the company has to generate in order to meet that demand. There are two ways to get this number. The first method is to come up with the number yourself. Some people will put the discount rate to anywhere between 10 to 15%. The more aggressive you think the growth is, the higher the discount rate. The second method is by using the WACC formula to come up with the discount rate. Or we can use this section to calculate it. Whichever method that you want to use is totally up to you. But I will just show you how to use the formula instead. First up, we need to look for the interest expense. So head over to Yahoo Finance under the income statement, expense net non-operating interest income expense, and you will see interest expense non-operating. Copy the number, head back and paste it in. For the total debt, we'll head over to Yahoo Finance again, click on the balance sheet where we will see the total debt. Since this is only for 2022, you can change it to quarterly, copy the total debt, head back and paste it in. Next, for the income tax expense, we can head to the income statement and look for tax provision. Copy the number, head back and paste it in. As for the income before tax, again, head to Yahoo Finance and look for pre-tax income. Copy it, head back and paste it in. We are almost done here. Risk-free rate is the 10-year US Treasury yield. To get this number, you can go to Yahoo Finance at the top, mouse over markets, click on US Treasury bond rates. And the number that we want is at the Treasury yield 10 years. Copy this number, head back and paste it in. Finally, the market return is just what's the return that you'll be expecting to get from the market. The S&P 500 has historically returned about 10%, so I'll just put it as 10%. And with that, we have gotten the discount rate and is now ready to calculate the terminal value. The formula for terminal value is the last free cash flow multiplied by 1 plus perpetual growth rate divided by discount rate minus perpetual growth rate. And we end up with this number. Now that we have the free cash flow for each of the years, the next step is to find out how much all this free cash flow is worth today, or better known as the present value. So to do that, we can click on the first cell, type equal, select the current year's free cash flow, divide it by 1 plus the discount rate to the power of the year. We want to anchor the discount rate, so we add a $ to E and to 4. Next, we can just drag the cell all the way to the end to calculate for the remaining present value. The next step is to add up all the present value of the free cash flow to get the total value of the business, or also known as the enterprise value. This is what the business is currently worth if we just look at the money printing side of the business. But wait, that's not all. That's because if you want to buy the money printing machine and you somehow find that there's some extra cash sitting in it, let's say you find $100 million in it, obviously you'll be willing to pay up to an extra $100 million to buy this machine, right? So we have to add this part in. This is called cash and cash equivalents. To get it, we can head over to Yahoo Finance, go to the balance sheet and expand total assets, current assets, and you'll find cash and cash equivalents. Copy the number, head back and paste it in. Besides the cash portion, we also have to take into account the total debt of the business. So again, head back to Yahoo Finance, scroll down and you'll find total debt. Head back and paste it in. And ta-da! We have gotten the equity value, which is the intrinsic value of the company after we have taken into account the company's cash and debts. This is the value that we will be willing to pay if we were to buy the entire business. But of course, we are not that rich, right? So instead, we want to find out how much each share is worth. To do that, we take the equity value and divide it by the total number of shares. And ladies and gentlemen, we have finally found the intrinsic value of each share. With this number, we can say that based on the current stock price, the stock is way overvalued when compared to the intrinsic value. So that was a quick step-by-step guide on how to use the discounted cash flow model to calculate the intrinsic value of a stock. As you might imagine, this model relies a lot on our assumptions. For example, if I feel that the business would grow at 20% for the next 10 years, the business would suddenly look very undervalued. Or if you were to assign a much higher perpetual growth rate, again, the business would look cheap. That's why most professional analysts would use a bear, base and bull case models in order to see what a business might be worth under different assumptions. In summary, by knowing how much a business is worth, we can now better gauge what is a good price to buy the stock at. Anyway, that's all for this video. Hopefully, you find it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.